Welcome to the Credit Risk Management Advisory Podcast, where we focus on managing asset quality and borrowers during economic downturns. Today's credit risk memo tool is Getting Best Answers for Debt Repayment Solutions. At creditrma.com, we help sharpen regulatory credit risk rating and evaluation systems and support a credit culture that respects all internal stakeholders and every commercial loan borrower. We also examine key creditor tools to improve outcomes. Let's dive in. There are a couple of objectives today. Getting to yes. Understanding the need for complete financial reporting, internal analysis, and asking the right questions, identifying red flags and root causes. Next, getting enough data. Key reminders for the balance sheet, income statement, and other financial metrics. In the end, the expectations are this: finish the job. Get the necessary financial reporting, thoroughly analyze it, and ask the necessary deep dive questions, internally or even externally with the borrower, and identify the root causes of any issues. Start with getting financial statement information and financial reporting covenants in particular. And what's in your covenant structure? Having the appropriate financial statement reporting structure requirements in the loan agreement in the first place is paramount. This includes business and individual financial statements and corresponding tax returns. Most loan agreements obviously have adequate reporting requirements. However, some loan agreements may need to be adjusted for adequacy as the credit risk increases, but generally have a provision for the lender to reasonably request additional financial statement reporting from the obligated parties upon request. The question is, how will the borrower and guarantors react when the creditor requests financial reporting, especially for detailed financial reporting when that has not been the case in the past? Okay, now, as a reminder to the creditors, let's get something straight. The stakeholders who signed the loan agreements need to uphold their end of the agreement. Subject to the terms of the signed and agreed upon loan agreement, the parties will have their various rights and responsibilities and remedies when it comes to financial statement and tax return reporting covenants. From the inception, the creditor should make it very clear that the required financial statement reporting is fully expected throughout the term of the loan relationship, and to also make it clear that the creditor will enforce the provision and carefully weigh any covenant defaults, forbearance or waiver or what have you in the future. Additionally, a word to the borrower and guarantor. If you signed a loan agreement with financial reporting covenants, you must comply, regardless of whether you want to. And they should expect the creditor to, as applicable, enforce its default remedies if an unwarranted default were to occur, generally an increase in the interest rate to the default rate. And such remedies, where warranted, should be enforced. All requests for financial information should be specific and communicated in writing with defined remittance or due dates. The willing, when things go right? What is better than a cooperative and steadfast borrowing relationship through thick and thin? Many borrowers and guarantors will readily step up and take care of their responsibilities. Imagine that. And a strong creditor may be better able to assist a borrower with a problem loan by extending prudent workout or modification terms. The borrower and guarantor will gladly submit not only the necessary financial information on time or as requested, but step up and even offer the creditor additional lender protection, a higher or full guarantee amount, additional collateral, or to resize a loan and so forth. Borrowers should also prepare their own pro forma repayment solutions based on their own cash flow projection recommendations. This is the way it's supposed to be, right? However, do not be so sure this will be the case when push comes to shove. Pressures and stresses can change anyone. Let's talk about the unwilling when things go wrong. But like I said, what if the borrower and guarantor turn adversarial and become unwilling to provide the requested reporting? Their history of willingness is beginning to shift. Look at it this way. Perhaps the borrower needs to be aware that the creditor may have loaned the borrower and therefore have a greater interest in the company's assets more than the owner or guarantor has into the enterprise. From a leverage or creditor's perspective, it may be 1.5 times, 2 times, or even 3 times more debt than equity. Therefore, the lender may feel disdain for the borrower if the borrower does not step up and comply with all the terms of the note and the loan agreement. The borrower may feel similarly about the lender by not fully understanding the borrower's needs either. So revisit the given expectations. If a borrower is unwilling to provide the requested financial information in a reasonable period, the decision to retain or exit the relationship should be revisited. Using the utmost respect and goodwill, unless there is a well-documented and supportable reason to the contrary to forbear the loan covenant, the creditor should quickly enforce its remedies and pursue getting the required financial reporting, period. The creditor should never lend in the dark, if you would, but in the light. But bring the full necessary daylight to the table. How about the level of financial reporting detail? Get whatever level of detail is necessary. The creditor will have a set of current financial reporting requirements. However, to get to the root cause of financial deterioration, additional financial information may be warranted. There are numerous financial documents that may be needed that aren't typically called for, like a detailed aging reports for accounts receivable and payable, inventory reports, inventory or customer lists, copies of complete leases, detailed list of contingent liabilities, or full tax returns, and verification of deposits, and so on. Now, the internal analysis and questions. This can be a tricky part, okay? In order to save time and money in the long run, and assuming the proper financial reporting has been received, spread, and analyzed by analysts or underwriters, determine if the right questions have been asked. Stakeholders should review the analysis and be sure to ask challenging questions that may not have already been addressed. Look at the analysis through the eyes of an independent third party, somebody like credit review or internal audit, or maybe a regulatory supervisor, a bank examiner. Another way to think about it is to ask if credit administration or special assets have of themselves any really these deep dive questions that they need answers to, so that the proper risk rating can be identified. Some credits are known to be hands-off, if you know what I mean, to everyone except senior management, which can become quickly problematic. Too often, in the asset quality monitoring process, gaps or weaknesses exist without a full understanding as to why. Insufficient curiosity and rigor become apparent, especially when it comes to finding the root cause of declining financial performance in some of these cases. And there may even also be a lack of experience by the primary relationship officer or the credit administrator or other stakeholders, as serious economic downturns are not all that frequent. Such questions and answers, though, should be documented, not discussed, but then documented, and the answers sought and obtained by the obligated parties in short order. Don't stop until you get all the answers, even if you have to keep going back and ask for more information. Now, this is the hard part, the questions and the yellow and red flags. Zero in on the issues. Are there flags or no flags? Again, are there any yellow flags or red flags, indicators of potential problems? Most C&I exposures with increasing credit risk will have red flag warning metrics before too long. The point is that a conscious effort is given to confirm any red flags and why deterioration is specifically happening. Zero in on the target by asking as many questions and getting verified answers as needed. You must understand what management intends to do to cure the negative performance. I'm going to give you a number of little examples here of such yellow and red flags and indicators of problem loans. Working capital advances used for funding losses, like a business uses advances from a revolving line of credit to fund business losses, including the funding of wages, business expenses, debt service, or any other costs not specifically associated with the intended purpose of the facility. Next, working capital advances funding long-term assets. A business will use working capital funds to purchase capital assets that are normally associated with term business loans. Next, trade creditors not paid out at the end of the business cycle. And while the creditor may be paid out, some trade creditors may not get full repayment. This can cause a strained relationship as unpaid trade creditors may be less willing to provide financing or offer favorable credit terms in the future. So you have to pay attention to that. In turn, the business will become more reliant on the creditor to support funding needs that were previously financed by trade creditors. Next, overextension of collateral. The business does not have the collateral to support the extension of credit, causing an out-of-borrowing-base situation. Review borrowing-base certificates to verify that coverage meets the prescribed limitations established by the creditor's credit policy for the specific asset being financed. Next, value of inventory declines. If a business does not pay back the creditor after inventory is converted to cash or accounts receivable, the value of the inventory declines. Other causes of inventory devaluation include obsolescence, a general economic downturn, or, in the case of a commodity, market volatility. Declines in inventory value will commonly put a working capital facility in an out-of-borrowing-base situation and require the excess debt to be amortized and repaid through future profits of the business. Next, collectibility of accounts receivable declines. The increasingly past due status of accounts receivable or deteriorating credit quality of accounts receivable both result in the non-collection of receivables. This can cause an out-of-borrowing-base situation for the creditor. Next, working capital advances used to fund long-term capital. Funds may be inappropriately used to repurchase company stock, pay for subordinated debt holders, or even pay dividends on capital stock. How about accounts receivable? A slowdown in the receivable collection period. This symptom often reveals that the borrower has become more liberal in establishing credit policies, has softened collection practices, or is encountering an increase in uncollected accounts. How about inventory? Noticeably rising inventory levels in both dollar amount and percentage of total assets. Increases in inventory levels are usually supported by trade suppliers, and financing these increases can be extremely risky, particularly if turnover ratios are declining. The increase in inventory levels or lower turnover ratios may also be related to the borrower's natural reluctance to liquidate excessive or obsolete goods at a reduced price. As I said, many businesses are willing to sacrifice liquidity to maintain profit margins. A slowdown in inventory turnover. This symptom may indicate overbuying or some other imbalance in the company's purchasing policies, and it may indicate that inventory is slow moving. If the inventory is undervalued, the actual turnover is even slower than the calculated results. Existence of heavy liens on assets. Evidence of second and third mortgage holders is a sign of greater than average risk. The cost of junior money is high. Most borrowers are reluctant to use this source of funds unless conventional sources are no longer available. Concentration of non-current assets other than fixed assets. A company may put funds into affiliates or subsidiaries for which the creditor may not have a ready source of information on operations. Next, high levels of intangible assets. Intangible assets, which shrink or vanish much more quickly than hard assets, usually have very uncertain values in the marketplace. In some cases, however, intangible assets such as patents or trademarks have significant value and should be given considerable credit. Next, substantial increases in long-term debt. This symptom causes increasing dependence on cash flow and long-term profits to support debt repayment. A major gap between gross and net sales. This gap represents a rising level of returns and allowances, which could indicate lower quality or inferior product lines. Customer dissatisfaction can seriously affect future profitability. Next, rising cost percentages. These percentages can indicate the business's inability or willingness or unwillingness to pass higher costs to the customer or its inability to control overhead expenses. A rising level of total assets in relation to sales. If a company does more business, It will take more current assets in the form of inventory, receivables, and fixed assets. Be concerned when assets are increasing faster than sales growth, right? Next, significant changes in the balance sheet structure. These changes may not be the customary changes mentioned previously, but they are represented by marked changes spread across many balance sheet items and may not be consistent with changes in the marketplace, profits or sales, product lines, or the general nature of the business. This short ad is sponsored by the Debt Crisis Problem Podcast. Attention listeners, please join us at tunabudget.com to tune into the Debt Crisis Problem Podcast, where in plain English we discuss the 20 risks that could soon fuel a serious economic downturn. We explore critical risks that could trigger not only the downturn, but offer practical insights for navigating financial uncertainty. Join us for thought-provoking discussions that encourage transparency and awareness. Subscribe now to stay informed and be ready for whatever comes next. Next is to document the root causes. You will need to dig deep until we get to the bottom of the root. Clearly document the root cause. It should be entitled The Root Cause. If you're not 100% certain of the root causes behind the financial deterioration, then keep digging until you find the reasons. Why? Because to identify and apply the right risk rating, the accrual status, the covenant structure, workout repayment solution, and action plan, you must know what caused the deterioration or problem in the first place. Otherwise, there could be a missed opportunity to apply the optimal repayment plan, which could end up costing the creditor more time and money. Look who wins. As analysts and underwriters help identify root causes as part of the ongoing monitoring processes, overall quality and efficiency is going to improve. Risk will have been better managed, including an understanding as to whether financial performance covenants should be waived or forborne. It is also less expensive to manage a credit in the long run when appropriate action is taken at the right time, the first time. Management and lending staff will also become more enabled through improved decision-making. Borrowers will also take comfort knowing the creditor is aware of the issues and build trust with the creditor by keeping the creditor informed on its remediation progress through better communication. As individuals and teams work together to identify root causes, they become more accountable, more engaged, and will contribute more to the creditor's success through job satisfaction as well. Again, let's go through some key reminders and tips for key credit metrics, starting with cash flow. The debt service coverage ratio. It's basically the ability to repay. The global cash flow, whether to include individual and business cash flows. The interest reserved to fund interest on a construction loan. Monitor and know the adequacy of each borrower's ability to repay on a continual basis. It is critical to evaluate the cash flow trends, particularly declining trends, including a comparison to industry peer performance, and make sure extensions are not just covering up repayment issues. Consider the level and trend of the debt service coverage ratio in assigning a credit risk rating. In a downturn, the obligated parties may have increased demand from global cash flow sources, which need to be carefully analyzed, not double counting income, of course. Ensure complete business and personal tax returns are obtained from all obligated parties. Consider the financial strength of the obligated guarantors in the credit risk rating determination. Confirm the time the interest reserve is in place compared to the needed financing, and make sure any cash flows the property generates go to service the debt. Continue monitoring the project lease-up. Ask any necessary questions until you fully understand the current and projected cash flows. Next, let's look at net operating income, stabilized NOI, fully leased with maximum rental income, the vacancy impact, the direct reduction of rental income, operating expenses for CRE maintenance, the debt yield in a deal, its viability and stability. Determine why units are vacant and for how long, and exactly how the borrower intends on getting them leased up. Carefully review key increasing expenses from an historical perspective, and ask any necessary questions to understand extraordinary expenses. When monitoring a loan's performance, compare the current debt yield to that of the original loan underwriting debt yield and to policy underwriting thresholds for the same, as if it were a new loan today. A low debt yield will require additional analysis, and questions should be generated around increasing a personal guarantee, offering additional collateral, or even resizing opportunities to properly increase the debt yield, regardless who the customer is, okay? Especially the high-profile borrower and the depositor. Look at the deal as if the creditor had to take back the property with a current debt yield. Let's look at profitability next. Sales, top-line performance, the expenses, controlling costs, and, of course, the profits, the benefits at the end of the day. Measures the inefficiencies in sales and profit levels, controlling expenses, and a return on investment. Evaluate trends in sales revenues, gross profit, and net profit margins, and other notable cost and expense ratios. Determine the reason behind any material changes in these key metrics. Identify material expense trends increases as a percentage of sales. And what is the outlook? Understand what is driving the profit margins and what needs to happen in the future to improve them. Ask any necessary questions until you're satisfied. Next, let's look at the efficiency side of it. The inventory days, the days to sell average inventory, the receivable days, number of accounts receivable on hand, the payable days, the average time to pay trade suppliers. Detailed inventory reports can be used to conduct an inventory inspection by sample testing and ensuring accuracy, basically holding the borrower to account for any discrepancies, right? If there are, especially in a downturn, if there are material differences in the days on hand by comparison of values of similar same industry companies, continue with your inspection. Determine if and how much functional or technical obsolescence there might be in the inventory stock. With detailed current accounts receivable and customer lists too in hand, carefully analyze ineligible accounts receivables, past dues, concentrations, and so forth, and determine their collectability. If necessary, again, we're talking about in a downturn here, ask the borrower how much and when for all material accounts receivables to get a clear idea of how much will be collected and by when. Suppliers obviously play a key role in the success of operations too, so carefully analyze the days on hand over time and determine if the borrower is operating efficiently or is unable to pay its creditors on time. Similarly, get an AP aging report and, if necessary, ask the borrower how much and when thereto for material past due payables as to when these will be repaid. Let's look at leverage, funding sources and capacity, financial resources, earnings, debt capital, equity capital to meet obligations, the ability to manage finances. Determine the viability of each funding source and if these sources of capital are available or sustainable. How possible is refinancing and at what cost and on what terms? Is the sponsor or guarantor able or willing to inject additional capital? Is the projected period to delever to a sustainable level acceptable? Does the cash flow analysis rely on overly optimistic or unsubstantiated projections? Are the projections stress tested for a downside case? Determine the ability to meet obligations and the extent of any planned variances. Document poor structures and limited covenants if applicable. How vulnerable is the borrower to sharp economic and business cycle swings? And of course, we want to take a close look at liquidity. The sources: cash on hand, short-term funds, cash flow management, secondary sources, cash burn. Review the liquidity needs of the borrower and if primary sources are sufficiently available, or if secondary sources need to be liquidated to meet current obligations. Carefully review current maturities, the size and timing of payments, interest rates, uncollected receivables, obsolete inventory. Determine root causes for liquidity problems. If net cash burn exists, confirm how much time is needed before returning to positive cash flow and the sources to recapitalize. Carefully study the cash burn analysis as often as is needed and adjust the credit risk rating when necessary. Ask the borrower how it intends to lower the cash burn rate. Next, performance to plan, budget versus actual variance analysis, a performance evaluation, an expectation review. It's important to understand not only why the variances occurred, but to determine if the creditor has confidence in the borrower's budgets and whether they need to be stressed for the creditor's base case. Do you have confidence in future forecasting based on historical variances? And what reasonable adjustments are necessary? Is the budget overly optimistic? If you do not know, ask. Monitor revisions to plan, but get the level of understanding where the creditor has confidence in the borrower's projections. Variance analysis can be performed quarterly, monthly, or annually as needed. Next, a careful look at the pro forma outlook. Is the outlook realistic? The forecasting of their future financial performance, assumptions, the projections, the educated guesses, the cash budget, the budget plan on debt repayment workouts. During times of economic downturn, use pro forma cash flow statements to structure workout and loan modification repayment solutions. Ensure the statements are conservative in both revenue and expenses and include upcoming one-time expenses. Depending on how severe the economic conditions are, have the borrower prepare its pro forma statements with its own recommended repayments plan. It should include detailed, well-supported, footnoted explanations on the assumptions used. Tell them to do that. Repayment terms can be temporarily used with the frequency of updated pro forma statements adjusted as necessary. Risk ratings will similarly be adjusted according to regulatory guidance. Under extreme circumstances, a cash-in and cash-out monthly budget can be utilized to show possible debt repayment solutions as well. Let's next look at management, the succession plan, the transition of leadership. Economic challenges will be successfully unmanaged or managed by skilled leaders. Understand the borrower's succession and management planning for all the key positions, not just the most senior level. Are there recent or pending retirements? And how might those changes and their tangible contributions in staffing impact the borrower's competitiveness? You should know. Speaking of competition, new or pending direct competition. Think market share, or customers lost to competition, where there's a negative impact on their borrower's operations. New competition can affect a borrower's operations and ultimately its ability to repay its loans. The potential loss of market share could result in a decline in revenue and profits. Determine if increased price competition is likely, as new competitors may enter the market with lower prices, affecting profit margins and impact repayment ability. This may affect or result in increased marketing and advertising expenses. Understand the strategies management uses to be proactive in mitigating competition risk and how it differentiates themselves from their creditors. Thank you for joining us. Today we covered getting the best answers for debt repayment solutions, another essential tool for managing asset quality and commercial borrower relationships. We want to hear from you. Submit your own credit risk memo at creditrma.com and share your insights on navigating credit risk, including special risks in commercial lending. If you found today's episode valuable, please subscribe for updates on future podcasts at creditrma.com. Until next time, let's continue to conquer credit risk challenges. Thanks again.